Hey, what's happening, everyone? Happy Thursday. Happy July 3rd, the day before the Independence Day in the United States. I'm very excited, and I plan on eating a lot of hot dogs, catching some fish, maybe putting back a few Miller Lights. Who knows? I plan on having a good weekend here for the 4th of July here in the United States. I'm very excited for it. I hope you all have some exciting plans too. I haven't heard what Jason's going to do, but I kind of have a feeling he's going to be playing with his bees or doing something weird in nature this weekend. What are you going to be doing for the 4th of July, Jason?
Yeah, playing with the bees, doing the nature thing. But no, I'm going to Pittsburgh, so we'll be in
Oh.
Pittsburgh this weekend, so that'll be fun.
I was talking to a guy at the bar the other day, and he was telling me that of all the cities, he's been to a lot of cities in the US, almost all of them. Of all the cities in the US, Pittsburgh was his favorite. What do you think about that?
That's wild. And
Yeah,
I do not
I
agree.
thought so too.
I've been to like probably all of the big cities in the US. Like Pittsburgh is cool.
Yeah.
It's like very like rustic and it's a nice area, but like once again, would I say it's like my bucket list? No, no.
Yeah. It's a
Maybe
blue
there
collar city. It's not for
maybe
everyone.
he had some great memories there. Like I do have friends who like moved there and love it and like swear by it as one of the best cities ever. So once again, teach their own.
Yeah.
I've been to a lot of places. Pittsburgh's not the top of the list.
For sure. Well, we brought along a lot of charts today. It looks like we have about 10 charts here in the deck to go over today. There's a lot happening in the markets right now. So without further ado, let's just get into the charts, Jason. First up, you brought along this amazing chart of gold, copper, and oil. And if you're new around here, this chart probably won't be very familiar to you, but for those who hang out around Gold Rush a lot, they're very familiar with this cycle. You know, we say it all the time around here is that gold rings the dinner bell for the commodities, and then copper follows, and then that's followed by crude oil. We've seen it in just about every single commodity cycle. And we're betting this is exactly the same thing. So, Jason, is it time for this transition from just gold leading the commodities to uh, expansion and participation, where we see copper and the broader base and industrial metals? Is it time for them to participate in this bull market?
I think so. I think it's, copper. I think copper miners are speaking for themselves at the moment. I think
Yeah.
copper is looking really good. You want to own the copper miners. I think that's the safe bet. Once again, the cycle goes through phases. We'll see gold move and the gold miners and so on. And then we'll see the copper miners really take off. The first phase of that's usually pretty explosive. And we're seeing that already. And then we'll start to see the energy stocks start to really take off. But now it's the time to own copper miners. I think too many people aren't talking about it. I think it's the place to be. Energy looks great. It looks cool. It looks fun. Looks cheap. I think that's why so many people are interested in it. However, where the money's going to be made going forward is going to be copper. I think the copper miners are set up and ready to take off.
Totally. And that's something we've been talking about here recently an awful lot. And in the last edition of Commodities Weekly for the Gold Rush Premium members, we outlined our favorite setups in the copper miners. We have three amazing setups and then another that we outlined about a month ago. But all of those trades are working, and I think there's a tremendous amount of upside. Like I have targets that are double where the price is right now. And I think it happens within the next 6 to 12 months. And these are some really powerful trends that are just beginning. So, Jason, let's shift gears a little bit and talk about bonds and inflation expectations at large. Inflation has largely been tamed since the post-COVID inflation ripper. What did it reach? 9.5%, something like that.
Yep.
Uh, so it's down quite a bit from there, closer to 2% now, and this is an intermarket ratio of TIP, which is the, let's see, who owns this? Is it The iShares, yeah, almost every ETF's iShares.
Almost
It's gonna
almost everyone we
yeah,
use that's a big one is always iShares.
yeah. So that's the iShares Treasury Inflation Protected Securities ETF tip, and that's relative to IEF, which I believe is also an iShares bond ETF, which is 7 to 10 year bonds. And this is really a good gauge of what the bond market is pricing in for inflation expectations. If this line is going up, the bond market's pricing in higher inflation expectations, and if the line is going down, the bond market is pricing in lower inflation expectations. And Jason, right now we are sitting at the neckline of a massive head and shoulders distribution pattern. So, if and when this pattern resolves, which I think the odds favor, how do you think the bond market and risk assets at large will respond to that? Because this is a big deal. We've seen some major inflection points in the market whenever this ratio makes big moves.
Yeah, I think this ratio to me tells me a lot, and it tells me what we're looking for, but also it's just because it's tips and the way they're priced, you're going to see a lot of times where inflation expectations are actually moving higher, and then tips are not moving as high with inflation expectations. If you even look at a chart of tips absolute and you look at inflation expectations, you'll see that that's kind of, oh, sorry, it's alarm going off. But you'll see that that one kind of lags the other one. So once again, it's do I think this thing could move higher? Do I think inflation expectations are still going to move up? I do. However, this is a significant chart because if we start really to break down here, it's something to pay attention to. And I think that's the biggest thing that you have to take from intermarket analysis. I love intermarket analysis. It's great. And it's also just something to take some cues from. Okay, this is what's happening. This is what we're looking at. I do
They're
think
just more pieces to the puzzle, right? The market is
exactly.
it's an ever-changing puzzle with I don't know how many pieces, thousands, hundreds of thousands, I don't know.
Yep.
But this is just another piece of the puzzle that helps inform our market
That's a
action.
great way of putting it. It's a piece of the puzzle, and it's an inflationary puzzle, and it's something that we've continued to look at. And it's more just keep the evidence on your side. As we get more evidence that this is really taking off, we'll continue to update you guys, let you guys know. Right now, this is an interesting topping pattern, but how many tops have we seen that have moved to the upside lately? Quite a bit. So to me, head and shoulders patterns can just do two things. And Sam's really good at looking at this the right way, which is when you see a head and shoulders pattern, it can either be a continuation pattern. This could easily turn into a flag, ascending triangle, a pennant, and just break out to the upside. So once again, getting above that right shoulder, above that 1.16 area would tell me that, hey, inflation's probably coming back in a big way. Breaking down, we get below 1.14. I think that's an area where we're going to see, okay, well, maybe bonds are starting to do very well again. Maybe we're getting into a situation where the Fed is lowering rates pretty heavily and the rest of the bond market is following it, saying that growth is falling more than we think. So for me, I'm still at the point where I think growth and inflation are going to move higher. So I do think this ratio is going to move up, but I don't want to bet against it if you don't have to.
Totally, Jason. And there's a question in the YouTube chat that I wanted to address. Frey Lee asked if gold tends to trend sideways or if it continues to trend higher when we transition from that gold only phase into a broader commodity rally, like where copper is breaking out to new all-time highs.
Yeah, I do think so. Gold, and he asked this question on I don't know if it was him personally, but somebody else asked this question on my Twitter yesterday. But if we look at gold, once again, it's not that gold has to die off here. Everybody's kind of looking for that gold to just die and then copper takes off and then copper dies and then oil takes off. That's not the way to look at this. If you look at it historically, most of the time it's gold takes off. Then next thing you know, copper really makes a huge move and it's great. And then next thing you know, oil makes a huge move. None of these have to stop. That's the other thing about understanding intermarket analysis and understanding cycles. Is like you can't, like anybody who tells you they can predict this with 100% certainty and this is what's exactly going to happen, that's ridiculous. What we want to do here, and what Sam and I do very well, is understanding the technical analysis part of this. Meaning, when we're looking at gold and we're going, okay, copper's next, we're going to wait for opportunities to buy copper. We're going to wait for opportunities to buy copper miners. As these things are making either new highs, breaking out, some sort of pattern that we're looking for, we get more interested in these things. We don't want to just look at the cycles and say that's it. And if we look at gold historically, like look at 2020, for example, great example of this. I think it was 2018, October 2018, gold bottomed. Gold started to move higher. 2019, gold had its big move, finally got back over 1500 again. And then in 2020, gold got almost to 2000, I think 2100 at one point. And then it went sideways. And around that time, it went sideways from August 2020, basically until January 2024. And so when it went sideways, what happened? Well, copper took off. Oil took off even more so. Oil made a huge move all the way from really it was about $20 in the actual contracts, but the front month contract, as everybody knows, in April of 2020 went negative, and then that skyrocketed all the way up to $130. So once again, we don't know exactly how this is going to shake out, but I wouldn't bet against gold or gold miners here at all. I just think this is going to go with it. If you look at the 2000 era, something simple to understand here, and everybody can see it on the chart, even though this chart's a little messier than the other one. When you look at the chart, you see, okay, gold moved in 2000. What happened to copper? Well, then copper moved. What happened to oil? Then oil moved. What happened to gold during all those times? Gold just kept moving. It was the train just kept rolling all night long. If you guys know that song, leave it in the chat. That'd be funny. But once again, it just kept rolling up to the upside as oil was moving, as copper was moving. And it was actually the best performer during that time. And it moved for 11 years. I mean, that was it bottomed around 2000 and it topped in 2011. So once again, I wouldn't bet against gold here. I would just start adding exposure to copper and then look for adding exposure to oil when it happens. At the moment, it's not happening just yet, but it'll happen at some point.
Totally. Yeah. It's more of like a rotation thing. You want to hold your gold stocks that have been winning. Maybe you own a physical gold position that's been a huge winner over the last year. Maybe you don't want to sell that entire position, but you unwind a quarter of it or something to rotate into some more fresh copper miner setups. It's a sector rotation thing. We see it in the stock market all the time, and the commodity markets function in a very similar way, with that sector rotation being the lifeblood of a bull market. Jason, let's shift gears again to currencies. Right now in the
Yeah, but
US
it's
dollar.
like I made the charts, but you made the charts.
Exactly. In the US dollar index futures, right now we're seeing the largest commercial hedger net long position since 2021. And you can see that on the chart here. This is right when the index was bottoming out and entered one of its strongest uptrends of all time. So, Jason, I guess the question for you is not whether we're about to have the strongest uptrend of all time in the US dollar. Let's see if we can get back above 100 first. Do you think this positioning kind of gives the Bulls the benefit of the doubt that they'll scoop and score and get this thing back in the range, back above 100? Or is this going to continue falling apart?
I don't think so yet. I think it's getting there. I think we're starting to get to a positioning that will create a bottom. And once again, it's hard, as you know, Sam. It's hard to understand exactly when that's going to happen unless it's a massive extreme that we haven't seen in a long time. This is an extreme, but it's not the most massive extreme I've seen. This is something that I think could unwind into 100. I think we will see a bounce in the dollar. That's the most I would say about it. Will I be selling any of my currency positions against the dollar? Absolutely not. Do I think the dollar could bounce? Sure. It just depends on your time frame. If you're trading in the short term and you're a magician trader, which don't really exist, but you think you exist, and you can catch the bounce to 100, and you can sell it perfectly, go for it. Some people can do that. I cannot do that. Not my thing. But I'm looking for this to still have more downside, Sam. I think this thing could go all the way down to 90. I don't think that's impossible for it. There'll be bounces, there'll be some positioning unwinds, but I think this thing's still headed lower. But I think it'll bounce at some point, right? Like you're not wrong in thinking. And once again, markets love to make a fool out of everybody. So I could sit here and say all this, and then the market could get back up over 100, and then maybe I have to sell those positions against the dollar. It happens. That's how you trade. You always change with the evidence. That's all you can do. But for me right now, seeing the momentum to the downside that we got in that move, basically we had that massive positioning going into the beginning of this year, and then it just came down like a ton of bricks. And when you see that type of movement from the top of the range to the bottom of the range, and then breaks down through it, usually that continues lower. So I still would think this is headed lower. I just think, we're going to have just looking at the overall market. This is where the intermarket analysis comes in, the puzzle pieces, as Sam said. When we look at China, when we look at Brazil, when we look at Colombia, Chile, I could go on and on. Europe, I gotta mention Europe. I can't believe I have to mention Europe these days, but I absolutely have to say that. But Europe looks great. It looks phenomenal. And so, what are all these countries priced in? Like they're priced in currencies against the dollar. So they're all doing very well. Their currencies are getting very strong. If we look at the commodities, gold, copper, they're getting very strong. The only one that isn't really is oil. Most of the commodities look like they're bottoming or shaking out, or they were already ones like cocoa or coffee that already ripped. So I'm still looking at this situation as the dollar's probably headed lower. It's probably going to push the international stocks a little bit higher still. And I think that situation will probably happen into the end of the year. I think that's a continuous situation, something that we are going to look back at the end of the year and go, wow, Poland's up 70%. That's crazy. Like Brazil had a 50% year, wild, like things like that, I think are going to be said. And so many people are still in the camp where, and this is the reason why I think this is going to continue. I put a piece out about international stocks on Tuesday. I got 5 emails from people, and I'm just talking about my little Substack page, so it's not like a ton of people on there. 5 emails from people, all saying how oh well, priced in their own currency, it's like this. This trade is stupid. Stop buying international stocks. You're going to get killed. I'm still hearing that stuff, and it's like I could get stopped out on every single one of those trades right now. Like let's say there's a crash and all of them crash tomorrow. Every single trade would be in profit. Like majorly in profit. Nothing not little, but majorly into profit. So I'm very happy with the moves. I think they will probably continue. And I think that too many people are still betting against it happening, and I think they feel the same way about the dollar.
We've got OVO Bone in the chat giving a shout out to the Polish Zloty, the Zloty. And then we also have Trey in the chat. While we're talking about the dollar, Jason, could we discuss its relationship with bond yields? Historically, there's been a pretty tight correlation there, but as of late, there's been a pretty major decoupling between bond yields and the US dollar. So do you think that's going to continue? Do you think bonds don't really care about what the dollar is doing? Or is it kind of the same trade? Where's your head at with that?
So when we're looking at yields, so many people get stuck into the, correlation is high now, so therefore it will stay high. Correlation can stay high for a long time. Correlation can stay low for a long time. And if we look at it historically, there's been plenty of times where this has shifted. I think that when people initially look at yields, they go, okay, look at the short-term rates. When the short-term rates are high, that means cash is making more money. That means the dollar is more valuable. Meaning, if you look at a money market, back in, let's say 2020 was about, you make like 50 basis points, and now like you could make like 4%. Sounds like cash should be worth more money then. But once again, it's always relative. Like, what is the euro doing? What's it doing in China? Where is cash being treated best? Should I have it in stocks? Should I have it in commodities? Should I have it in bonds? So I think the way to really look at this is, one, this relationship changes over time. The yield will change over time, not to mention it's relative. And then two is look at the trends. If we're looking at a chart of, let's say, the 10-year yield, and Sam and I have been talking about this, where it's like, okay, like the surprise trade of the year would be yields going up, not down. And that would fool the most people. And honestly, the market likes to fool most of the people most of the time. And the dollar is moving down. But if you look at I'm not talking about the Fed rate, I'm talking about long-term yields. If you look at long-term yields, 10 to 30 year, you're going to see them consolidating to the upside and ready to break out higher. So I don't think that's something people have to worry about as opposed to the dollar. If you look at something like Japan, for example, their yields are much higher than ours. Not the actual rate, but the rate of change of it. It's made a huge move. A lot of these yields in these other countries have moved up a lot more than
I
ours.
saw the UK bond yield was screaming higher. I think that
Yep.
was yesterday, maybe that was Tuesday, but
Yeah,
yeah.
I mean, we keep seeing that over and over again. So to me, there's no reason why the US yields can't move higher. But once again, think about it this way. If we are looking at it just as bonds and the idea of relative to Europe, and you are seeing like Japan's yields moving up and you are seeing European yields move up, then that makes perfect sense why the dollar is actually under more pressure, even though our yields are kind of holding up pretty high because their yields are moving up higher and faster. So I think that that's something to continue to look at, continue to monitor. But really, to me, I try to take that whatever way the trend's moving. If the trend is moving down in yields, I'm going to say the yields are moving down. If we're seeing this consolidation in the middle of a huge continuation pattern and a possible breakout to the upside, I'm going to probably bet on it moving high.
That's a great point you make there, Jason. And, you know, for this entire cycle since 2020, if you want to be on the right side of the trend in bonds, the best move has been to look at what's happening in bonds around the world, not just to look at what US bonds are doing, but look at the German bonds, look at the UK bond market, the Spanish, Italians, look all over the world and you'll get the trade right. It doesn't need to be that complicated. Just use the intermarket evidence to tell you which way to lean. Now, Jason, the home builders are making moves. This has been near the top of my list for the bull market to continue. If home builders are one of the most pro-cyclical, economically sensitive groups in the stock market, and they've been terrible for months, almost years now at this point. And the price recently resolved a massive top and it looked like it was about to fall apart, but then buyers showed up right at the prior cycle's peak and it's been off to the races ever since then. And this week we're reclaiming that VWAP anchored to the all-time high, completely undoing that top and frankly shifting the path of least resistance towards new all-time highs. And if you overlay the home builders with something like semiconductors or Nvidia or some of the other most important areas of the stock market, they all look very similar. They all had these topping patterns and some of them resolved lower and stayed lower, but semiconductors and Nvidia and Microsoft have all reversed that top and gone off to make new highs. And another thing that I think is really interesting with the home builders is that you have the short interest in the home builders, the XHB, making new 52-week highs and climbing out of a massive base right as all of this is happening. So, I think there's a really sound fundamental thesis that you can make for home builders, home building stocks struggling, but we're seeing the exact opposite, Jason. These people that are making bets based on their fundamental outlook, those are probably the short sellers here, and I think they're about to get squeezed out of their positions as they realize that, the entire market's making a new leg higher. So what do you think the implications are for risk assets at large of home builders not only not falling apart and going to zero, but they're actually participating in this bull market and catching up to the leaders.
You know what's interesting about that, Sam, is when we look at home builders, everybody has been, this is another one where everybody correlates with yields. Well, if yields are going lower, home builders are going to do great. Man, home builders have ripped and yields have been moving higher steadily. They've been either way, whether they've moved sideways, they've been elevated. Home builders continue to rip. I think we're looking at something that's very similar to India, for example. India moved up a lot. And if you look at a chart of, I think INDA, there's a couple of them, but if you look at a chart of India, you'll see it looks very similar to this, meaning it had a massive move off of those 2022 lows that happened in October 2022, and then it kind of went all the way up, and then had a nice crash, came back down quite a bit, and then now it's trying to move higher. I think this looks very similar, where it's like, hey, that was a huge move, and most of the time when you see huge moves, you will see a consolidation. I'm sure if you threw a fib on there, you'd probably see that it came to about 38 or whatever. It didn't retrace 50% of the move, but it came in quite a bit, and now it's ready to move higher. That's a normal move in an uptrend. Yes, it was bigger than most people would have wanted or expected. Yes, the arbitrary bear market number of 20%, I'm sure, happened. Please don't use that. It's ridiculous, but it does. Some people do use it. But I think this thing is probably set up to move higher here. I think it consolidated, it broke down. I think it's just a nice pullback. It looks very orderly, and now moving up higher. I think it's got a lot more to go. And if you look at some of the paper stocks, Wood ETF and so on, and you look at XME, you look at XLB, all of these things look great. And so most of the time when those are moving, you see the home builders move, actually not only move, but lead the way. So I think home builders are ready to start leading the way once again.
Yeah, love it. And Jason, let's finish today's conversation with some precious metals because we are in the best month of the year for silver futures. This is going back over a decade now, and July is not even close. This is by far the best month of the year for silver futures and for silver miners. So this is SIL, this is silver futures. And, Jason, this is all happening at a very big level for silver futures. 35 is what we've been watching for years now as the 61.8 retracement of this 2011 to 2020 drawdown. And last month we closed above there for the first time in decades. And now it seems like the path of least resistance is shifting higher above 35. I think silver is going to 50, and I think July could be the initial leg higher out of this massive base. So what do you think about all that? Are we about to have a double-digit return for silver during the month of July?
Everybody keeps asking about silver to me, Sam. I posted that chart yesterday. It's got gold, copper, oil. Everybody goes, well, where does silver fit into that? And just to give a great answer and give it very quickly, it's here. Now, once again, how do people look at it? There's a couple ways. And so I used the KST signal yesterday. But my favorite is always 52-week high. So 52-week highs, we've already hit it. It's already moving. Yes, it didn't make a brand new high. I'm sorry about that. Sorry to myself as well. But once again, I don't think it's not going to get there. I think this is really taking off. I think this is really going to hit $50 pretty soon. Maybe the month of July is enough to push it. Sam and I've talked about this a bunch where I mentioned, August, a lot of the time we see these tops. So July, we see a lot of punch in the moves. And so once again, I think that silver is probably going to head higher here, probably to 50. I think that where it fits in the cycle is if you look at gold and then copper, it's between there somewhere. And most of the time it's hey, are the gold miners moving? Hey, are the junior gold miners moving? The answer to all that is yes right now. Absolutely. 60% on GDXJ at one point, 57% on GDX at one point.
Since gold futures broke out on March 4th of 2024 to new all-time highs, the silver miners ETF has been the best performing asset in precious metals. It's up 102% over that time frame. And then you have the junior gold miners, which are up 99.5%, rounded up to 100. But, it's been incredible for these precious metals. And you mentioned there, Jason, that silver is kind of a mix between gold and copper. It's kind of a precious metal. It's kind of a base and industrial metal. It's not clear. exactly what it is, and it's probably somewhere in the middle between those two. And not only do you have gold turning sideways near all-time highs, but you also have copper futures breaking out to new all-time highs on a monthly closing basis. I mean, what else can you ask for? Like right here, right now, it's time for silver to go to 50.
Oh, I think so. I'd be very surprised, especially go back to that chart for 1 second. So especially because when we're looking at those peaks, if you lived through that and traded that peak that where the resistance is that everybody keeps saying, oh my gosh, what about 50? What about the old highs? That peak happened so quickly. Is this a monthly? I can't see. Yeah,
Yeah, this is a monthly chart. Yeah, it was just one little monthly blow off
yeah,
candlesticks. Like
one
there's
month.
not a lot of volume up here. It's going
Yes.
to move fast from 35 to 50.
Yes, it was a very quick top. It didn't feel very good for anybody who was long silver. Full disclosure, that was me. So basically moving up and then just boom, right back to the
It
stop
was an
there.
amazing uptrend though. You know, it went from $7 to 50 in how long was that? 2 years?
Yep.
So like it's hard to complain. You
It was a
even if
great
you got
move.
out 25% from the peak, you still crushed that trade.
Yeah, it still made good money. It still was a great trade. It just was like you were in it and you were like, oh, cool. And then it just was like boom, right back to the trailing stop pretty quickly. And that happens at times, and that's why we use stops because we just sometimes you just don't know perfectly.
And
And
you tend to see that in commodities a lot too, Jason. You want to speak to that a little bit
oh,
and,
great
and
point.
how they spike a lot more than, a lot of us are traditionally equities traders and didn't cut our teeth in commodities like you did. So
Yeah,
talk about
it's
that.
commodities are they if you look at stocks, they V bottom a lot. And yes, this is silver, so it's a little bit different, but most of the time you can see that these are very long consolidation patterns and then they move at the bottoms. And then the tops, they V top and they go down quick. So it's the opposite of stocks. So stocks usually kind of start to slow down and then they roll over, and commodities start to base and then they go higher and then they V top. And so you're seeing these V tops here, and that's going to scare people because they're going to be like, oh my gosh, we're going to V top here. No, I'm not saying that at all. I don't think we're anywhere near a V top for silver. I think we're going to at least hit 50 before we see any sort of pullback or turmoil in this. But I'm just saying, like, this is something to pay attention to. This is the reason why, like, you'll talk to a lot of futures traders and they'll say, like, yeah, I use trailing stops. I always have a stop. They swear by these things and they're crazy about it. And the reason why we are is because this stuff happens. It's going to happen here and there. You're not going to have a perfect trade. However, if you don't take those trades, like Sam was talking about, this thing running from $7 all the way to $50 is not something that you can catch very easily if you don't take the trade, or if you're trying to trade it and say I'm going to hit this target and get out. You would have hit 7 or 8 targets before before this thing ever really took off, and you'd have been taking money off the table. That's why in commodities we like to use these big long-term trend models. So I do think silver right here, it just doesn't have much resistance. There's not really anything holding it back from going to 50. So as long as we're above 35, to me is really my line in the sand. I think we can move up to 50 pretty quickly.
Totally. And let's finish today's conversation with a little materials, Jason. You brought along this chart of the XLB. This is the S&P 500 materials sector ETF. And here it is making new 100-day highs. And, if you go through all 11 of the S&P 500 sectors, you'll find a lot of them are breaking out to new all-time highs. But, materials have just been stuck in the mud for years, ever since that prior cycle's peak. It's just been a huge mess. But it's really shaping up and looking very constructive, if I might say. And the XLB SPY ratio this week on Tuesday, it had its best day in years, best day since January 6th of 2021. And Jason and I were talking about this before we got on camera, and I was like, Jason, what happened on January 6th of 2021? And he's like, he couldn't really come up with it. And I just said it was a political thing. And that was
No, I
when
said it.
The crazies were storming the Capitol, you
I said
know?
capital. I couldn't even remember
Yeah,
exactly what it was. I said capital, but yeah,
yeah.
yeah.
On
Don't
that day, they were dramatically bidding up commodities, betting on chaos happening as the capital of the US was being stormed. And that's exactly what we saw this Tuesday was the biggest bid for material stocks since that day. So I think this could be an early indication of a new uptrend to come here. And then you also have that 100-day high to confirm that move. And Jason, just a little pop quiz here. What do you think the best performing stock inside of the XLB has been so far in 2025?
hmm, that's a tough one. I bet it's
Yeah.
a chemical stock.
No, you would be wrong.
NEM?
NEM, yeah.
NEM?
Newmont Mines, one of the largest gold miners in the entire world. It's
I
about
was gonna
4
say NEM
point,
first, but then I was like, it's got to be more tricky than that.
right, yeah. It's about 4.8% of the XLB. So far in 2025, it's up about 63%.
Wow.
Yeah.
So I mean, look, it's a sector that is completely unloved. We're talking about chemical stocks. We're talking about copper miners, gold miners, you name it. There's a lot of stuff in there.
Steel miners,
Steel
Nucor.
miners. This thing really takes off when it moves. And once again, if you go back even further to look, and this is the reason why, like I always tell people to look at very long term charts. And the reason why is like you get an understanding of like what XLB did in the past. What did these stock look? And if you need to go back further, look at U.S. Steel, look at NEM, like see what these things did in the past cycles, like 2000 and 2011. It'll blow your mind. You'll be like, oh my gosh, what? Why didn't I ever own these things? And this is the way the cycles work. Is it's not just a hey, technology is going to be great. Markets go through boom and bust cycles, and it's not just about hey, we're going to have a crash tomorrow. Like I'm not saying that by any means. I'm saying that innovation happens. So if we're looking at let's say 2010 to basically 20 today, basically we're talking about technology making a big move from smartphones all the way to AI. Now we are all the way here, and now we're at a situation where it's okay. Well, are we going to shift the cycle? Are we going to? Did we had that huge boom? Now are we going to move into a boom in the commodity-based sectors? And it really looks like it could happen. Once again, I'm not saying like go sell Nvidia and run for the hills. I'm just saying like don't be afraid to move into different things as the year goes on. I think about 2021, and just like you said, January 6th. I told Sam, I said, I don't know. We were making a lot of money then. And at the beginning of that year, we had a big move in the commodities complex. Basically, anything that was commodity based, XLB, XLE, financials were doing well. All the commodities were ripping. It was a heck of a year. And then I was also sitting at a dinner with a bunch of fund managers, and we're all sitting there one night, and they say, hey, how's your year going? They're all going back and forth about it. Oh, they all had a tough year. I was like, well, how did you guys have a tough year? Well, there was just the market didn't go up that much, and the S&P outperformed me. And I was thinking, like, how is that possible in 2021? Well, the answer is easy, which is technology. Technology didn't do that well that year in comparison to all these other sectors. Now, technology had a huge run in 2020, and then it kind of stalled out, and then XLE, XLF, XLB, XLI, these things really took over. So, we had a great year at my fund because we were also investing in all these different commodities. We're investing in these different sectors. We're invested in global stocks, even had a great year that year. So that's the reason why I'm always like telling everybody, like, please look at all these sectors. Please really dig into the data. Don't just look at the United States and go, I live here, or I understand the United States has performed so well for so many years. Like, sure, that's happened, but once again, look in these other areas because there's a lot of value, a lot of opportunity. And when you get to, because it's always going to happen at some point, when you get into those years where technology is underperforming or the S&P is underperforming in a way, you're going to want to know the sectors that are outperforming. And sometimes they are. It's as simple, like people always hate the phrase there's a bull market somewhere, but I do believe that. I do believe there's always a bull
I
market.
think that goes along with the whole, like we always say, sector rotation is the lifeblood of a bull market. And, whether it's a bull or a bear market, I think you can always find something that's working. That's true, Jason. But it works the same way in bull markets,
Mm-hmm.
and it's
Been better in
to
bulls.
your point. Yeah, like it's not always technology, but you can have these big moves. Sometimes they're mean reverting in nature. The laggards catch up to the leaders, and maybe say technology is the leader. It's been going up for a year, just in this hypothetical scenario, but materials have done nothing for this year. So then maybe technology just goes sideways for a quarter while material stocks scream higher. And that's what you're talking about there, Jason, that dynamic of these people who only own tech stocks, during that entire quarter or whatever time frame we're talking about, people that are overexposed to a certain trade, a certain theme in the markets, they're really going to struggle. But those of us who are willing to trade anything that's trending, really, we really thrive during those times when there's rotation.
I agree. That's the biggest thing that we always have to think about as traders is even if, like, let's say we're in a situation like 2022. Energy actually did great that year, but let's pretend energy was just flat.
It
Let's
was up
say,
like 60% in 2022.
yeah, it was good. It had a very good year for the XLE. But just let's say it was flat. Let's say you rotated to commodities, you rotated to all these things, and you just had a flat year in 2022. Well, the broad market was down 20%. The S&P 500, the Nasdaq was down even more than that. If you look at what else was there, the bond market was down over 20% that year. So if you look at those things and you go, okay, well, I was just in XLE and it was just flat, and I was in, XLB and it was just flat. Like, you're still outperforming. You're still doing well. Now, there were plenty of trades that year. The first quarter of the year made most of our money for the fund that year, and the rest of the year just kind of chopped sideways. But once again, like, I'm happy to leave the year with a nice return that's over 20-30% rather than leave the year with a negative 20-30% return because I was like, you know what, technology is going to work forever. And I know a lot of people will go, well, Jason, technology did come back. I know we bought that too in 2023. Like in January 2023, the breakout happened and we got long technology. There's no reason to hang out in a drawdown because you think it's going to come back. That's what a lot of people do. That's what new traders do. That's why they lose a lot of money. What we're trying to do here is teach you guys how to really make money, keep that consistent. Because really, think about it. Think about it in a simple term like a math problem. If you have a 50% drawdown, you have to make 100% to get back to even. So, if you're only losing 10% on the pullbacks or you're having flat returns for a while or something, like, you can always make more money. It's the biggest thing I learned when I started working with funds was, hey, I just want you to try to not lose money. That's the whole lesson that we got at the beginning. Like, your idea here when I first worked at the prop firm was try not to lose money. And I was like, well, that's going to be hard because, how do you make money then? He's like, well, if you can, basically the idea of risk management, only lose 1%, try to gain 5% on your winners, 1% of your overall portfolio on your losers. And really you can make money over time. And I thought that sounded crazy at the time, but it's the truth. So the idea here is consistently move to the things that are showing relative strength, and you will never be a losing trader. Consistently understand risk management, relative strength. That's how you make money.
100%, Jason. And every week we're talking about making money at the gold rush. So if anybody found what we had to say interesting, check out the link in the description. You can see our reports that we're putting out every single week, whether it's currencies, bonds, commodities, precious metals. We're covering it all here at the Gold Rush for $12.99 a year. And if you don't like what we have to say, you can get your money back within 30 days, no questions asked. On Friday, we were talking about it earlier in this episode. We outlined our 3 favorite copper mining stock setups, and man, those are some sweet setups. So if you want to get that, check out the link in the description, and you can see that report. I appreciate everybody being here today. OVO Bone, the Optionist. We've got Michael, Trey, Frey Lee. Everyone's in the chat. I appreciate you all being here. This was a ton of fun today, Jason.
Oh yeah, I mean I love it. I love seeing all the stuff in the chat. Mag looking like a nice way to play silver. Like I mean we if you guys check out the Gold Rush, we got a lot of these trades. And the one thing that we're good at there is Sam's really good at figuring out which miners you want to be in at what time.
We buy the leaders, Jason.
We buy the leaders. That's simple, as simply as we can put it. And basically the whole point of this entire conversation is continue to buy the leaders, continue to buy strength. Don't go, oh my gosh, gold is up a lot, I better like get rid of all my positions. Go, gold is like, this is the thing that's the hardest thing to teach people as a trader, which is bad traders, not even bad, just new traders. I did this too at the beginning. When things are going against you, you get more optimistic. You're like, okay, cool. This is lower. It's cheaper. Maybe I'll add to this position and so on. And then it just keeps breaking down on you until finally you go, oh, I got to get out of this thing. Good traders, when things are moving their direction, they get excited about the position. That's when they get optimistic. They go, okay, good. You know, the market's proving my thesis correctly. It is telling me that gold, I think gold should go up, and gold is going up. Therefore, I'm right. So once again, it's going to be hard because you're going to look at it. I mean, I get things this entire cycle in gold. I have gotten more tweets and more just random thoughts about where gold is going to end up and how it's going to crash than I ever have in my whole life. And so people are basically like, okay, you know, I have this triple top thing that people keep sending me. Oh, you see the triple top in gold. Oh, you see this top. No, like you bet on the trend until the trend breaks. That's how you make money. Like, and I'm not even saying like you got to trade long term and you got to buy it. I'm saying you're seeing here a consolidation pattern. Instead of looking at it like a top, look at it like a continuation pattern, because most likely in an uptrend it will continue. At some point, I will be wrong and that will roll over. But we've been right about that consolidation. Sam has updated the chart for our subscribers over and over again. It just keeps going sideways, nice breakout, sideways, nice breakout, over and over and over again. This would be just another one. And I think it's probably headed to 4,000. And then we also look at silver, and that's probably headed to 50. No reason to bet against it yet.
Totally. You reminded me of the Whipsaw song. For those of you that are not familiar, look up the Whipsaw song on YouTube. This is a song by Ed Sakota, one of the best systematic trend followers of all time. And this guy got so frustrated with whipsaws and experienced it for so many years that he made this song dedicated to whipsaws. And you need to check it out. But in that song, he said he rides the trend until the end. You know, like bull markets climb a wall of worry, and you can think that this is a top, but the odds are that the trend is going to continue higher, and you just need to let the market prove to you that the trend is over, and until then, just ride the trend until the end, like Ed Sakota said.
Absolutely.
Cool, Jason. Let's leave it there. This was awesome. Again, I really appreciate everybody being here, and we will catch you all the same time, same place next week. Have a great and a safe 4th of July, everyone, and try to enjoy the great city of Pittsburgh, Jason.
I will enjoy it. I'm not hating on it like it's a bad city. I like Pittsburgh, but I'm just saying, like, I'm from Cleveland. What's the difference? You know, like
right.
Rust City. Pittsburgh's a little bit bigger, got some more, maybe some funner things to do there. But once again, it's like, I want to go see, I like to see the ocean. I like to see mountains. I like to see country, and I like farms. So, you know, for me, it's there's a lot of city.
Well, I hope you enjoy it either way.
I will. I'll have a good time. That doesn't mean I won't have fun. I have fun at home anyways. So.
Right on. Me too. All right, everybody. Adios.
All right, guys. Take it easy.